Big shot at redemption for big tech. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Alex Steele, and we are kicking you off to the closing bell right here in the U.S. Let's get a check here.
Welcome back, by the way.
Oh, thank you.
Yeah.
I have no idea what time zone I'm in, by the way.
Okay, well, rabbit.
I think it's 3 p.m. Oh, man. Apparently that's a thing. What is also a thing is the S&P up by 0.1%. So a different story than what we saw yesterday. Will big tech deliver after the closing bell, and will that help propel gains even higher? NASDAQ 100 also up by 1 percentage point. I wanted to point out, though, other stuff that wasn't doing well, and that's definitely the regional banks, is the KBW Bank Index. This is all about New York community banking and sort of the downgrades that we've seen pretty much across the board and sort of bleeding into other areas. All the regional banks are part of the worst performers within the S&P. Now, on the flip side, you are seeing a bid into the bond market. Part of that is that really strong ISM manufacturing data that we got out earlier, and you have yields at a year-to-date low. Sure, it's been just a couple weeks, but nonetheless remain lower yields, and again, maybe a risk-on kind of day after yesterday's sell-off.
All right, well, we talk about sort of what's actually moving this market. We talk about Microsoft, Alphabet, AMD really trying to claw back some of the losses after, well, really letting the market down on Tuesday with those earnings results. We get another trifecta of big tech companies reporting tonight. Apple, Amazon, Meta, potentially giving the tech trade a shot in the arm. At least that's a hope. Expectations vary, though. Investors largely looking for a return to revenue growth over at Apple, some clarity from Amazon on integrating AI, and some improvements in ad targeting at Meta that could potentially add more fuel to the expansion of that core ad business. Now, the importance of these companies to the market and really the performance of their stocks can't be understated. Keep in mind, Meta accounted for 13% of the gains in the S&P alone in January. Amazon, about 5%. You throw in Microsoft's 25% contribution and NVIDIA's 47%, and well, you're looking at a quartet of stocks that accounted for more than 80% of the S&P gains so far this year. Now notice, I didn't mention Apple or Tesla, two members of the Magnificent Seven that have been less than magnificent to start off the year, with each right now nursing year-to-date losses. That could change in a big way once we get to the 4 p.m. hour, and that really does bring us to what happens when we get to the bell and beyond, Alex. Here, expectations are high, and so too are valuations. Bloomberg Intelligence took a look at these tech companies and said right now the tech premium to this market is at about 38%.
I love that stat. And this was kind of do you have the Vision Pro, by the way?
I don't. I'm waiting till the price comes down to maybe like 2,000 instead of 3,000.
Not like 3,500. Yeah. Okay. So this is the chart that Romain's talking about, and it shows that tech premium. So this is the price to earnings multiple for tech versus the S&P. The higher it goes, the more tech is trading at a premium to overall tech. That's what that blue line is. The dotted line here are the standard deviations from this 5-year average, which is that orange line. That just means it's a really fancy way, thank you, Gina Martin Adams, of saying that tech is just quite overvalued right now to 38% premium if you're looking at 28 times earnings versus the overall S&P at about 20 times. Now, in order to re-rate to the norm, you would have to see the sector's premium fall 18 percentage points. Just to put all of that into perspective, Romaine.
Yeah, absolutely. Let's kick things off here with Jeremy Bryan, portfolio manager over at Gradient Investments, as we count down to the close. And Jeremy, more importantly, counting down to 3 big earnings after the bell. We already got a preview maybe of what to expect, particularly out of Microsoft and Alphabet. And while I know the initial share reaction was to the downside, the results weren't all that bad. What are you expecting tonight?
Yeah, I mean, I think you hit the nail on the head, is that the results were way better than the actual stock reaction. And I think that's, part and parcel of just what you were just talking about with regard to valuations and just how well these stocks have worked. There was high expectations coming in. And so when you don't blow numbers out, chances are you're probably going to get a little regression. And that's what we saw historically. Coming tonight, I think it's a lot of the same. A little bit more of, I think there's probably a little bit more consternation about Apple just with regard to can they grow? And, some of the channel checks haven't been coming through quite as well. So I think Apple is probably more of not even an expectations game, but just how is the business actually doing game? Whereas Amazon and Meta, can they continue to do what they've been doing? We need to see stabilization to reacceleration on the AWS side. Mm-hmm. And then on the Meta side, just kind of continuing with, Google's ad numbers came in okay. They weren't great. They weren't rock star. but they were okay and they were good enough. I would say that under normal circumstances, probably would have been fine. Can Meta do the same thing while continuing to be cost cutting and continuing to rationalize costs so that their earnings are growing faster than their revenue line?
I mean, all of these are relatively attainable things to achieve when it comes to the communication, but you have to sort of put that against the backdrop of the big rally that we saw in these stocks. A big conversation right now about valuations, and I was taking a look at some of the data coming out of Bank of America and showing this huge sort of outflow out of stocks, and particularly out of tech stocks. I mean, it doesn't take a genius to see that there's some profit taking here, and I'm wondering if all the good stuff has already been priced in.
Yeah, I mean, so I think priced into an extent for it to continue to work, you have to have earnings that are excessively better than expectations. I think inline is just not good enough, right? Given where we're at, given what the valuations of these companies now are, it is expected to be a beat, or else it is just not good enough to continue to sustain the rally. So that's where I think the expectations are right now, is they're elevated. I mean, even the core numbers, if you come in and meet or even slightly beat numbers, that's probably looked at as somewhat disappointing just because of how extended the rally has become with regard to the performance of these stocks. I mean, and you said it on the valuation earlier, is the valuations of these stocks is pretty darn high right now, and that just creates even higher expectation levels. So priced in certainly right now, that can always exceed if numbers are significantly better than expected. And that's what's required to keep them going.
Yeah, Jeremy, I was reading a piece that said, look, it doesn't actually matter what the numbers are. It matters how the stock trades after that, which really speaks to your point. So I guess the question is, like, what do you do then? So Mike Wilson of Morgan Stanley was on earlier today, and he talked about, do you play sort of the lower quality? Do you play higher quality? And what do you do with tech? Here's part of what he had to say.
We don't think the trade is to then go to the lower quality bucket, okay? To go for the low quality cyclicals, and like that's a recession trade. We're not in a recession. You need a clearing event. That was our call in 2020. Then that worked really, really well. Don't overthink it, right? You need to buy the high quality growth stocks, and it's not all Mag 7.
Do you agree? Is it actually not all Mag 7?
No, and it's not even all tech necessarily. I mean, the two overweights of the Mag 7 that we're actually overweight aren't even really in tech, right? I mean, they're comm services and consumer discretionary with regard to Amazon and Google. But I mean, even outside of that, think of something like Constellation Brands, right? Which is working very well here recently because their numbers are exceeding and their valuations are actually reasonable. So just because you eliminate, and don't even say eliminate, reduce your tech exposure, which we're seeing a little bit now, you can diversify into other companies without suggesting that you're going into low quality. Low quality doesn't only live in technology. It lives in a lot of other places. You just have to look at where there's examples of better cases and better valuation stories to where they're still exceeding numbers and have better valuation upside than maybe what you're seeing in the tech landscape.
Well, you mentioned Constellation Brands. Is there another type of sector? Like, that's really consumer discretionary. Like, that feels a little risky if we don't know where the economy is going to go. What other areas do you like then?
Yeah, Constellation is actually kind of more staple oriented. I mean, it's beer for the most part, and Modelo has been gaining share. I mean, you could honestly call that somewhat of a secular growth story, just in the effect of the market share change that Modelo has been experiencing has been continual growth going forward. And that's what we're looking at. I mean, look at another staples name is like Procter & Gamble, right? I mean, they were expected to have real headwinds as a result of inflation, but they're massively executing on their plan right now to where the numbers were significantly better. And, I think there's individual pockets of those kinds of things in all sectors, in all landscapes, and even in tech, there's certain regards. I mean, Broadcom is certainly elevated to where it was before from a valuation perspective, but isn't abnormally stretched when you look at average valuations compared to the overall market. So there are certain pockets and avenues that you can take advantage of, even if you have to. And again, I'm not saying you eliminate your Mag 7 stocks. You just maybe reduce them and put more into these other areas.
All right. Well, I think some investors are taking that cue already also of the Magnificent Seven stocks in the green, pushing the NASDAQ up by more than 1%. The S&P up 1% and now breaching that 4,900 level as we speak. Jeremy, we have to say goodbye. Jeremy Bryan, portfolio manager over at Gradient Investments, and with a focus on tech. Some breaking news just a little while ago involving Docusign. JP Morgan, Bank of America are among some of the Wall Street banks said to be in talks to provide as much as $8 billion in financing to buy out Docusign. That would value the company at about $13 billion. Other companies also said to be involved, including Jefferies, as well as Deutsche Bank. Some questions here about how much of a role private capital would play in this. Financing a deal like this would end up being one of the biggest private capital deals on record. All right, a lot more coming up here on the show, including some excerpts from my conversation with the CEO of Royal Caribbean on the heels of the launch of that largest cruise ship in the world, on the heels of a big earnings beat. Alex.
Plus, you got tension still simmering in the Red Sea. More on how it is affecting shipping costs and supply chains. We're going to talk to Gene Soroka, Executive Director of the Port of Los Angeles.
And the IPO market heating back up. Amerisports, the owner of Solomon and Wilson, now debuting here on the market. We're going to take a deeper dive into the sports equipment maker as our stock of the hour. All that and more coming up in just a bit. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with the big one. New York Community Bank Corp. Shares of the regional lender selling off for a second day amid at least 2 downgrades. That includes a re-rating from buy to hold over at Jefferies. The analyst saying if credit risk remains an overhang for the bank, the path to better profits going to take quite a few more years. Shares down about 7% on the day after that 38% drop yesterday. Moving on to packaged foods. Citi starting coverage of the sector, and that includes a sell rating on Campbell's Soup. That's cold. But the analysts just aren't confident that margins will grow as expected. Campbell's current guidance factors in a sales rebound in the second half that the analysts say is likely implausible. Nevertheless, those shares getting a modest boost on the day by about 0.3%. And finally, let's turn to Qualcomm. KeyBank boosting its price target to 180 from 165. We had the analyst John Vin on just the other day here, helping to break down those earnings. He says today that the results were strong and they reflect the recovery in the handset market. Nevertheless, those shares taking a leg down, almost 5% here on the day, and that looks to be part due to some of the comments the company made about elevated inventory. Those are some of our top calls, but we do want to stay in the sell side space and push ahead to the big tech earnings after the bell, and that includes Meta. Investors surveyed by Bloomberg looking on average for EPS of about $4.91 on a GAAP basis on a back of $39 billion in revenue. But investors, they also want details out of Mark Zuckerberg about improvements in ad targeting and AI recommended content that could sustain expansion of that core ad business. Ali Mogharabi joining us right now, senior equity analyst over at Morningstar. He's one of only 3 of the 70 analysts covering Meta right now that has a sell rating on the stock. All right, Ali, let's start off here. I mean, this is a company that's actually pieced together, at least right now, a couple of decent quarters of revenue growth. The expectations for the most recent quarter is that trend line continued here. What are you expecting?
Well, the Q4 numbers are probably going to be pretty impressive. I mean, we're seeing some indications in terms of ad prices, especially on social platforms, social media platforms, that did increase near the end of last year. There is increasing demand because there's less uncertainty regarding the macro environment going into 2024. So you could expect continuing growth in ad spending. And of course, regarding the bottom line, they continue to operate very, very well, increase efficiency, continue to implement those cost controls, expand those margins. So from that standpoint, they're executing exceptionally well. We just think that all of that is pretty much priced in right now. And that's why we think that the stock is a little bit overvalued.
Well, I am curious, and it certainly is. I mean, we talk about a 32% run up just since the last earnings report. And last time I looked at the RSIs, we were basically in overbought conditions. But you had a buy rating on this stock at one point, or at least your team did last year. I know that got ratcheted down to a sell at the start of this year. What can you hear later tonight on that conference call and out of this earnings report that would maybe give you a little bit more confidence to upgrade the stock to something better than a sell?
Well, mainly what we'd like to hear is mainly revenue growth acceleration, because this company is still extremely dependent on advertising revenue. And if you look at ad spending going forward, although the economy is not going to, of course, go into a recession, the growth is going to slow down. And from a macro standpoint, when the growth slows down, ad spending slows down. So if they give excellent guidance, over 20% top line growth, then it's certainly going to be very, very positive for the company and for the stock. But that's not what we're expecting. So the top line growth is the main focus for us right now.
Is any of this, Ali, going to be an AI payoff? Like, where we're going to hear the words AI in terms of sort of juicing up the conversation around Meta?
Sure. I mean, there are two different types of AI payoffs for not only Meta, but also Google and some of the other big techs. One is basically how the implementation of AI internally can help the company operate more efficiently, right? So, and of course, that will help basically, operate leaner, right, cut the fat, expand margins. And then the other is, how can that company make it easier for its clients to, for example, go through the process of implementing their campaigns on their various platforms, whether it's Facebook or Instagram. So I think that's where artificial intelligence is going to benefit the company. I think over the long term, we'll probably see those types of benefits in terms of margin expansion and in terms of top line growth. But for now, though, of course, all of this would require additional CapEx because you need additional data centers, you need additional computational capabilities, and all of those things to enable all of that artificial intelligence.
Right, which is basically what we saw with the other big tech guys related to AI. You have to just pay out more in order to get more. What CapEx number makes you worried? I think anything over basically 5 to 10% above what they guided for at the end of Q3 for 2024 would have us rethink some things. Hey, Ali, we really appreciate it. Thank you so much. We know you're going to get a busy afternoon, but thank you so much, Ali Mogharabi over at Morningstar. Thanks a lot. All right, coming up, we're going to hear from the CEO of Royal Caribbean as the cruise line's outlook tops estimates on record bookings. Have you done a cruise, Romain?
No, I'm looking to do one, but I think I'm going to wait till I'm like 95 when I could really enjoy it.
5-10 years, kind of down the road. It's like right around the corner there. Okay, this is the close on Bloomberg.
Time now to take a look at shares of Royal Caribbean hitting some rough seas today, even after reporting initial profit guidance that was actually well ahead of what the street was looking for. The company also seeing record demand and a negligible impact from tensions in the Red Sea. I had a chance to catch up with the CEO, Jason Liberty, just a little while ago, and I asked him how confident he was about that forecast for 2024.
We don't guide planning for perfection. So our expectation very much is that we're going to deliver on our yield and margin and return profile. This will be the first year in the company's history that we're going to generate a return on invested capital in the teens, and we're really proud about that.
You paid down a lot of debt in the most recent quarter. You've got some maturities coming up in each of the next 4 years here. How are you sort of preparing, I guess, for those maturities coming down the pike? And are you still on a path to an investment grade credit rating?
Sure. We paid down almost $4 billion of debt. Most of that was from the cash that we were generating from the business. So we expect to use the cash that we're generating from our business to pay down debt, to get back to the balance sheet we had pre-COVID, which is about 3.5 times or better. We expect to be kind of an eyelash away from that by the end of 2024. So when you look at the financial health of our organization, we are back more or less to where we were pre-COVID. And of course, we at the same time continuing to invest and grow our business.
Well, as you grow that business, you're sitting there, of course, on the Celebrity Summit docked in Miami. I can't really see behind you here, but what's the progress on that new headquarters in Miami? Headquarters, of course, construction of which was disrupted by the pandemic.
Well, interesting enough, in about 2 hours, we're gonna do the official re-groundbreaking of the building. We're a business that is growing. We attract the best talent in the world because we wake up every day and we deliver smiles and happiness to people. So we're a beacon for talent, and we need to have space to be able to do that in. And that building will be done here in the next couple of years. So we're really excited to get that back and going.
When you talk about growing the brand, I'd be remiss in not bringing up the new partnership with the MLS and the Miami team there in Major League Soccer. That season kicking off in a couple of weeks, and there's going to be a new logo on the jerseys of the Miami team, including, of course, one very important person, Lionel Messi, and that's going to be the Royal Caribbean logo. How did you negotiate that deal, and how much did it cost?
Well, I won't get into the specifics of the cost of it, but what I will say is that the Inter Miami team, the Moss family, Beckham, they're heavily dedicated, just like we are, to deliver an incredible experience and be the very best of what they do. And those are things that we believe in. It also is a great builder of the community here in South Florida. And that's what we look to invest in. We look to invest in our communities that support us. And if we can make the community around us better, it helps it better for our employees and also helps a better experience for our guests. And that's how we came to the relationship with Inter Miami. And we're very proud of what they're trying to do. And of course, we're very proud to have the crown and anchor on the jersey.
How much of that is a relationship with Inter Miami, and how much of that is about Lionel Messi himself? I mean, were there any sort of conditions in the agreement that if he were to leave and depart, that would change the terms of the deal?
Yeah, well, I won't get into the details of it, but our relationship is with Inter Miami, and as he is certainly the GOAT of football. But they've also done a great job of bringing in other players onto the team, and it just shows their dedication. To really build, just like we try to do at Royal Caribbean, build a great team around us. They're trying to also build a great team around Lionel.
Jason Liberty there, the CEO of Royal Caribbean. And Alex, I mean, you should know a lot about what's going on in the cruise sector. You just got off, like a 2-week Eat, Pray, Love cruise to Italy, right?
Yeah, totally. That's
what was that like?
Yeah. I was definitely not at an oil conference, basically, in Florence. But what's interesting is that I feel like the cruise ships are trying to basically be Vegas on a boat. And that is the whole idea.
Oh, yeah. Well, the thing is, they say that. And what I thought was fascinating, which I just kind of learned about, was they've actually created now their own land islands, effectively their own ports where people can get off and do their thing, kind of circumventing the whole process of getting on and off in the actual countries themselves here. So he was very cognizant of that. He kept using the phrase, land-based vacations, and that's what they're up against. They're not competing against the other cruise lines. They're competing against land-based vacations.
Exactly.
Yeah.
But you have to wonder, too, if the economy, if people start struggling and they have to allocate their dollars, if we're not going to go overseas anymore, is this going to be a beneficiary of that?
Yeah. Well, he says they've actually started to close that price gap. He said that gap between what it would cost to do a land-based trip versus a cruise was like 40 or 50% gap just a couple of years ago. And that's now, I think, according to him, about 15%. So a 15% premium to, travel around the world on a cruise ship.
So my daughter just learned about the Titanic. So she is she's seen pictures of this, but she is completely paranoid that a big cruise ship is going to hit an iceberg and we're all going to die.
Too soon.
I don't know where she learns this stuff. She's 9. I mean, who knows? I didn't
learned
talk
it from
about
you, Mom.
I thought she'd be into the slides and stuff, but anywho. All right, coming up next, you got tensions are still simmering in the Red Sea. More on how it's actually affecting shipping costs plus supply chains. We'll also talk about the end demand as we head into the first half of 2024. Gene Soroka, Executive Director of the Port of Los Angeles, will be joining us next. This is The Close on Bloomberg.
Just about 3:30 here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So, Romaine, what I found really interesting today is that ISM number that came out.
Yeah.
Prices paid within that spiking higher.
It did.
I spoke to the guy behind the numbers, Tim Fiore, on radio, and he was like, there's a material price inflation risk. And
price inflation risk.
That could really reaccelerate. I don't think we're prepared for something like that.
Well, but the manufacturing number came up a bit, right? So doesn't that kind of balance out maybe?
Maybe.
Yeah.
He thought the biggest risk was really that inflationary scenario when it comes to materials.
The market seems to be looking past that. I mean, you see the price action today. Some of that, of course, due to earnings and some other things, but some of that was also due to the economic data itself.
I know, that was kind of a head scratcher. But it does lead me to wonder about what if we get the tensions in the Red Sea keep accelerating and you have container price shipping rates keep accelerating, what the risk is on that. So we have a decision by most top container liners are rerouting their vessels around Africa, and that is causing that rise in inflation rates. Now, nothing that we've seen since back in 2020, but nonetheless, here's what some of our TV guests on Bloomberg had to say about the situation.
We are adapting to those circumstances, and we are really focused on keeping our mariners, our people safe, and protecting our assets. and doing everything from going around the Cape to swaps. But what we are trying to really focus on is making sure we honor our commitments to our customers through this difficult period.
We've seen the increase in shipping costs from Asia to Europe. They've increased quite substantially as ships have to be routed around Africa instead of going through the Suez Canal. So the costs have increased. Right now, the impact, the global impact, if you want, on on the cost of importing goods and on overall price levels has been very limited.
This is a minor blip for us, so it costs us some weeks in terms of having to ground the Horn of Africa, but by and large, we've now got those pipelines primed. It won't be a big consideration for us, I think, going forward in terms of customer deliveries or in terms of costs.
All right, let's get more insight now with Gene Soroka, Executive Director of the Port of Los Angeles. Hey, Gene, it's always good to get your perspective. What are you noticing when it comes to having to reroute around the Red Sea?
Good afternoon, Alex. Great to see you, too. What we see is that the Suez Canal is the lifeline for Europe on Asia-based origin commodities. About 70% of container traffic that goes through the canal is destined for the continent, the Mediterranean, and the UK. The balance, 35 or 30 or less percent, is coming to the east and Gulf Coast of the U.S. So by and large, with the segments that you just showed, those three gentlemen speaking about the supply chains, I'm in agreement, but it still is a significant event when we're talking about the safety and security of our crews, cargo, and assets. Reminds me of the time working in the Middle East when the Somali interests were patrolling the Red Sea and going after vessels. There was work from NATO through the Allied forces to try to create safe passage. Going around the Cape of Good Hope adds about 14 to 21 days transit time to these ships as compared to going through the canal, and about $1 million per voyage. But again, for U.S. imports, it's a relatively small percentage of the overall intake.
But Gene, I appreciate that part of it, but then the U.S. has to contend with the Panama Canal, and that drought situation backed up tankers and then having to pay more to get through. Are you seeing that on your end?
A little bit too, Alex, and about 5% of cargo traffic around the world goes through the Panama Canal. Suffering from these drought restrictions over the past number of months, the Panama Canal Authority is made up of a group of folks that really know what they're doing. Shuttling cargo from the west side of the canal over to the east by rail and moving it onward is one of the stopgap measures they're using. Here again, looking back to the west coast of the United States and the Port of Los Angeles, we're running at about 75% of capacity and have noticed a little bit of an uptick of cargo that would normally make its way through those two canals coming our way. Majority of this boost that we're seeing for a very strong January and an equally good February is that pre-Lunar New Year rush coming out of China specifically.
Well, talk a little bit more about this. I mean, that investors, for that matter, are still concerned about some of the disruptions in, let's just call it, I guess, the supply routes themselves. There are still labor issues that also have to be sorted out. You've done a good job so far in dealing with some of those union issues, but you've got another big contract expiring later this year. I'm wondering, where do we stand right now in those talks, and what are the preparations right now if a deal isn't struck by September?
All right, Romaine, three big pieces that we're watching in the industry this year. One, a lot of vessel capacity coming online that has been ordered over the past several years. So it's still a buyer's market for importers and exporters. That excess capacity is also helping when we talk about those longer routes being witnessed now around the African continent. Secondly, it's an election year. So, folks, we'll try to jump ahead a little bit in guessing on policy matters and the normal trepidation that comes along with that. And then thirdly, as you mentioned, the East Coast dock workers will be in the midst of their negotiations. Now, this is a group that hasn't gone on strike since the mid-1970s, but their demands will be strong, and the employers will have to respond to that. Yet here again, we have capacity on the West Coast of the United States to ensure the American economy keeps moving.
We've seen, of course, some of that capacity get used up, reused, I should say. Are you back to some of the levels that we had prior to the pandemic in terms of the L.A. and Long Beach's ports' share of the total amount of goods coming into U.S. ports?
Not quite yet, Romaine, but it's been encouraging. Since that tentative deal was reached between the West Coast Dock Workers, the International Longshore and Warehouse Union, and the Pacific Maritime Association Employers Group, we've seen a 4 percentage point uptick in market share throughout the Trans-Pacific. And again, that's cargo traversing across from Asia or going through those two canals. So noticeably upward tick on that volume coming through and the associated market share. Still more work to do and capacity that can handle it.
Hey, Gene, can we get to the demand side here? What's your sense of where stuff is going? Is it end user, like am I buying it, or are companies kind of restocking inventories? What's your sense?
Two big segments of our cargo, Alex, as you know, about 25% of all the imports coming through here are finished retail goods going through the domestic supply chain so we could buy either online or in store. Another 25% are parts and components going to the American manufacturing community. Those orders continue to be strong as well. And what we've seen from the most recent economic data, great retail sales numbers in December. You and Romain were just talking about the ISM numbers and a downward look here that continues to be encouraging. Even the Atlanta Fed boosted their first quarter GDP outlook just this morning.
All right, Gene, always great to catch up with you. Gene Soroka there. He's the executive director at the Port of Los Angeles. And, of course, we've all been obsessing over our supply chains in a way that I don't think we ever have, at least not in my lifetime. I didn't get a chance to ask him, though, about this new terminal project they have, because this was a big issue during the pandemic when they had that surge in goods. Remember, it wasn't so much getting it into the port. It was getting it off the ships and onto a rail car or to a truck, and they just did not have the capacity to do that. So that's a capacity issue that I think is going to become much more of a concern, that now that they're winning back a lot of that business that they had lost over the last 2 years.
Yeah, I remember sort of the maps. You can go to the maps on the Bloomberg terminal. You could see like the line of ships, like literally off the coast. I thought that was quite interesting.
And remember how many of them got rerouted to either Gulf states, or in some cases even all the way to the East Coast, like Savannah and those places, even though some of those ports were maybe a little too shallow. At least according to the data, a lot of that business is coming back to LA and Long Beach.
I have to wonder, too, that as we reshore, onshore, friendshore, over the medium term, right? It's not just tomorrow, but does that change? Like,
how's that going? I mean, I hear a lot of talk about, politicians say that, and I think I remember seeing like Biden with a hard hat with a shovel in the ground. Yeah, but is there actual factories and warehouses built?
Yeah, I mean, look at the Intel semi-chip, for example, factory.
Is that out?
But no, but that's the point. It's not today. It's over the next like 10 years, say.
I know.
And then at what point does that sort of disrupt the flow of goods that are coming in? Like, does it have a material shift?
Yeah.
Like, are we going to be stocking manufacturing warehouses from the Port of LA, or is it going to be from, Atlanta or
That's
something?
a good point. Or maybe we become so self-sufficient, it would be like the oil market. We'll just start exporting everything. So
until they stop telling you not to do it, and then everyone freaks out. It's a whole thing.
All right. Well, I don't think there are any national security issues going on with our next company, the newest kid on the block, Amerisports, debuting today. The latest IPO, health in the IPO market, Alex. You should be happy for this. Wilson tennis rackets, basketball, Solomon ski gear, Arc'teryx coats. I don't know. There's something else I'm probably forgetting there. Anyway, that's our stock of the hour. It's coming up next. You need a Louisville bat?
No.
Okay. All right.
I spent my budget in Florence.
All right. We'll be back. This is The Close. This is the countdown to the close. Romain Bostic here alongside Alex Steele. A check of the clock tells me, Alex, we're 10 minutes away from those closing bells.
Do you like round numbers?
I do like round numbers.
Okay, so we're just a little bit below 4,900.
Oh, okay. I want to hit it right on the dot here because, I had hats printed up.
We're literally one point away.
Yeah,
so you made your wish.
Yeah, I could have printed it up for like $48.99, but that would have been a little wad.
So that's where we are for the S&P. The NASDAQ is sort of off its highs, but still pretty much doing well. Two stocks just to watch, guys. You got Peloton down 24%. This is where the 52-week low today.
Am I supposed to be surprised by that?
No.
Isn't this what Peloton does?
Yes. No, not surprised. Maybe to the extent then of how surprised the street was when their outlook just wasn't great.
Yeah.
And also Qualcomm having a hard time kind of convincing the street that they're going to really be able to deliver some meaningful growth here.
I'm fascinated by this because it really is indicative of what we've seen this earnings season, right? It really isn't just about the numbers because the numbers were good.
Yep.
It's about the communication and what they say and whether the street is going to buy it. And at least based on what you had there on the screen, investors aren't buying it today.
Yeah, they're not. Maybe they'll buy it after the bell.
All right, let's get some insights out of our next guest, Nancy Tengler, joining us right now to help us count down to the bell, CEO and CIO at Laffer Tengler Investments. And Nancy, we're setting up here for another busy day after the bell in terms of tech earnings. And I do kind of want to go back to some of the tech earnings that we've already had that I guess we can kind of say we're a bit disappointing, at least based on the market reaction to them. And it's raising a lot of questions right now about market leadership, whether we can continue to look at the Magnificent Seven, or at least a good portion of them, as being the leaders for the rest of the year.
Well, thanks for having me, Romaine. I think a couple of things. I mean, you know that we've been proponents of tech since the fall of 2022. I mean, we owned it before that, but we were adding to the names. I think you need to be very particular in here. So I didn't think the Microsoft report was negative or disappointing. I thought it was quite remarkable. But the stock has run. I mean, it's up, almost 100% from the bottom in 2022. So it is okay for it to breathe. But if you go back to the 90s, and I've drawn a pretty strong analogy to this economy and this market to the 1990s, Microsoft was not nearly as interesting as a company as it is now. And it was trading at 51 times peak earnings. It's currently trading a little bit above 30 times not peak earnings. Mm-hmm. So I think with all the opportunities and the secular tailwind behind cloud computing, generative AI, digitization, this is a name that you want to continue to hold. And they did deliver pretty strong cloud growth. Mm-hmm. Earnings growth was up 33%. I mean, I can't argue with that.
Yeah. I was taking a look at some of the investments there over at Laffer Tangler relative to the broader market here, an equity growth strategy that outperformed the S&P, and equity income strategy that outperformed the Russell value, and a best ideas list that really walloped the Dow Jones Industrial Average by like 30 percentage points. What exactly were some of those best ideas, and are they still your best ideas here in 2024?
Yeah, so I wrote a piece on this recently. When I was a young portfolio manager, there was an article that said optimal diversification, 12 stocks in any portfolio, and it was in the Journal of Portfolio Management. The problem is nobody really has the courage to do that. And so we've done it, and it always, almost always, not always, outperforms. Of course, it's more volatile, but we own names in there like Palo Alto Networks, ServiceNow, Microsoft, Amazon. We own Chipotle. We own Home Depot. Public Storage, Goldman Sachs. So it's not all techie, growthy names, but there are really important things that we're looking for. And they're catalyst for outperformance, and then the management team. And I think if you look at a name like Amazon that's reporting today, Andy Jassy got Tim cooked when he took over. Nobody thought he could do it. The stock sold off, and we were buying pretty aggressively in the fall of 2022, but also in January of last year when the stock got down to the high 80s, low 90s. And so he's done all the right things, and I think he's proven himself. And so today's report is going to be very interesting.
Nancy, let's tie a couple things together. There is a headline that's just crossing that money market fund assets reach $6 trillion for the first time. And I'm wondering, as we see yields continue to come down, does that money in the money market funds go elsewhere? And if so, does that belong to tech? Does it belong to other parts of the equity market?
Yeah, Alex. So you've seen flows into the tech ETFs, but also last year you saw about $240 billion go out of equities, and still the market was up, 26, 27% on the S&P. So I think you will begin to see, it's not going to be all the funds, but at the margin, you'll see funds coming back into equities. But even more important than that is share buybacks. That is going to be a remarkable floor under this market. And if you look at the Magnificent Seven, I think they're I think they've announced they're going to buy back $190 billion of stock in 2024 per Bloomberg. And Apple is $100 billion of that alone. So even if you don't like the Apple fundamentals, you are going to get a floor from the company on the share buyback side. And that's, more flows into the equity markets as well.
So straight up buy the dip for you, Nancy?
Yeah, I think so, pretty much. I mean, I wouldn't be in a hurry. Mm-hmm. I'd take my time, pick away. But yeah, I think you do want to own stocks in here for the next, foreseeable future, 18 months to 2 years.
Let's get to another question here, Nancy, because I am curious about this idea that when you sort of fold in all of the expectations around the Fed and rates and how that sort of feeds into valuations, are a lot of the moves that we saw to the upside, meaning in equities, was there a direct correlation we can draw there to that drop in yields, or at least the expectation that yields will continue to drop?
I think so. But I also think that the market, for the most part, except for yesterday, has really stopped listening to the Fed in terms of timing. I mean, we just heard a few weeks ago or a month ago that we're going to stay higher for longer. And then the next press comments, that Powell made were, hey, we're thinking about cutting rates. So I think, and that's been a history, we're not even thinking about raising rates. We're not going to go 75, then they go 75. So I think the market's looking at the fundamentals, and those PMIs, I heard you talking about it earlier. The PMIs and productivity are huge. And again, that's an analogy to the 90s. We had high interest rates, 5 to 7% on the 10-year for the entire decade on average, 3% inflation, but it was productivity due to a labor shortage companies spent on technology. And that productivity improvement is really what drove stock prices, which were up, over 400% for the S&P and the Dow and over 800% for the NASDAQ. I wasn't just alive then. I was managing money. This feels a lot like that.
Yeah.
And so I think we want to stay tuned and, sort of tune out the noise that comes from the algos trading the headlines.
And this is exactly why we like having you on, Nancy. Just the breadth of knowledge and the understanding of history, really unparalleled. Always great to talk to you. Nancy Tengler there, CEO and CIO at Laffer Tengler Investments. As we count down to the close, 2.5 minutes to go here, Alex, and stocks still at session highs.
Yep, around session highs, that nice round number. Really looking forward to some of the earnings here. I'm having a hard time getting excited about Apple, though.
No, why not?
I'm not going to lie.
Why? The Vision Pro doesn't float your boat here?
Number one, but also at some point you just reach.
Number one. What if we put the close on the Vision Pro? Because apparently nobody else is on the Vision Pro, so maybe we can be there. Stick with us here. We are moving closer to those closing bell. A slew of earnings coming up as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell, and here to help take us beyond the bell, it's a global simulcast, joined now by Scarlett Fu, Carol Masser, Tim Stenovic. A hearty welcome to all of our audiences across our Bloomberg Properties, television, radio, originals, and that partnership with YouTube. Carol Masser.
Yes.
How you doing?
I'm doing really well. Market's doing well, especially if you're trying to be a bull in this market, because you've seen buying kind of into the close. I do wonder, we're all getting awaiting those earnings from Amazon, Apple, also Meta, whether or not we find some enthusiastic reports, because I feel like what we've gotten this week so far has been a little bit disappointing, to say the least.
One area where I'm not seeing excitement, in fact, one area I'm seeing under pressure is regional banks. It's something that we continue to think about because we're seeing the KBW Bank Index actually down in the last 2 days more than 8%. We all know why this happened. New York Community Bank surprising with a dividend cut, fourth quarter loss, and provision build. Guys, we keep asking every guest, is this something that is contained to New York Community Bank? And that's what we're hearing, or is it something bigger? We're hearing more and more that it's contained.
Right, but the commercial real estate market is very, very slow moving, so it'll take a while for this to all shake out. In the meantime, we got data that, for the most part, was pretty mixed. Jobless claims rising to a 3-month high, but manufacturing PMI came in higher than expected. So how does that fit in with Jay Powell shooting down that March rate cut?
Yeah, but it all really comes back to, at least for the equity market, I think, to those valuations. And even if you don't think we're going to get those 5 or 6 cuts that are priced in, even if you get 2 or 3, at least that makes a case here for yields to go down. And if you believe in that negative correlation with stocks, then in theory, stocks could go up. Clawing back some of the losses that we had yesterday from what was one of the biggest sell-offs we've had since September and October. A Dow Jones Industrial Average looks like it's going to finish out the day higher by about 1%. The S&P higher by about 60 points or 1.25% above, Alex Steele, that round 4,900 level, 4,906. I don't have a hat for that.
I heard you were obsessing on that before.
No, we just like our round numbers here. We just feel good about that.
Well, speaking of round numbers, take a look.
I'm not finished, Carol Masser. I'm not your brother.
Come on, buddy. We got earnings.
The NASDAQ Composite up 1.3% and the Russell 2000 up 1.4%. Carol Masser, take it over.
Get it done. Get it done. S&P 500, speaking of round numbers, well, not quite round, but a lot of the S&P 500 higher today, Scarlett. 401 I'm looking at right now as the market settles at 101 to the downside, 1 unchanged.
Yeah, and when you look at the sector performers too, 11 industry groups, 10 of them are in the green. You've got consumer stocks, whether it's consumer discretionary or staples, up by at least 2%. Utilities also up by 1.9%. Though a laggard here is really energy, and that's little change at this point.
All right, let's get to some of the individual gainers as we await those earnings. Amer Sports, actually, let's go to Amazon, folks. Here they come. All right, fourth quarter, AWS net sales. Actually, let's go to the big numbers. Fourth quarter EPS, $1. Big beat, folks. 78 cents a share was what the street was looking for. Looking at first quarter net sales, so we're starting to go into the outlook here. $138 billion to $143.5 billion. A little bit of a range there. The estimate on the street is $142.01 billion. As for first quarter net sales, again, we just did that one. First quarter operating net income, they're looking at $8 to $12 billion. Again, quite a range. Estimate on the street is $9.12 billion. We're looking at Amazon up about 2.3% in the aftermarket. Operating margin 7.8%. Another big beat. Estimate is 6.17%. So AWS net sales $24.2 billion. Estimate was for $24.22 billion. That's always an important one. And physical net stores net sales 5.15, 523 is the estimate. So that's a little bit light, but we're seeing the stock now up about 4%. Looking pretty good, guys. Alex, at least in the initial go through.
I was taking a look at what they said about China in their press release, talking about expanded tools and resources for sellers in China, talking about supply chain by Amazon for sellers in China, so less competition and more about their ability to capitalize on that. But Tim, the range from net sales to operating income for the first quarter is quite wide. I don't quite know how to read that, to be honest. I mean, clearly the market's taking it positively, but still.
Yeah, and look, I'm going through the press release right now, and I see what Andy Jassy said. It's incredibly long, and I'm going through it. What sticks out to me is what he says about AWS. He said its continued long-term focus on customers and feature delivery, coupled with new Gen AI capabilities like Bedrock, Q, and Trainium have resonated with customers and are starting to be reflected in our overall results. Lots of questions are going to come up today from analysts about, okay, what are we seeing in the results specifically from using those new generative AI capabilities?
I think one number that really jumps out at me, and one reason why you might be seeing the shares higher, are really some of these cash flow numbers. I'm not exactly sure what the secret sauce was, but you're right now talking about inflows on free cash flow of about $37 billion in the full year, I should say. So for the full 12 months, that compares to an outflow of about $12 billion in the previous 12 months. So that's a huge flip-flop. And even on the operating side, that cash flow increase was still at about 82% higher than what it was the prior year here. So maybe that has to do with some of the cost cutting that actually led to that big beat on that side.
Some analysts were saying that the best case scenario for Amazon here is a retail revenue beat, and we got that with online stores net sales, a margin beat, and it looks like we got that as well. And inline AWS revenue is slightly lower than what analysts were anticipated, but certainly growth from the previous year. And commentary suggesting Amazon Web Services accelerating in the first quarter. So that's what we're going to be watching for in the earnings call.
All right, so just to rehash here, folks. So we've got Amazon, up about 3.5%, 3.6% here in the aftermarket. You've got first quarter operating income, $8 to $12 billion, the estimate for $9.12 billion. Again, AWS, fourth quarter AWS net sales, $24.2 billion. The estimate was $24.22, so essentially in line. But again, the investor enthusiasm, Alex, with this one continues. And I agree, those numbers, when you look at cash flow, pretty tremendous that Romain pointed out.
I just want to point out, guys, something about Amazon Prime. This is the second quarter that they've had their Thursday Night Football. And we're looking at 24% year over year, double-digit growth for second season in that 18 to 34 demographic. That really paying dividends, no pun intended, for them. Netflix also getting into this game as well for WWE. That's quite interesting that they're also able to capitalize on that too.
I'm glad you brought that up, because something that investors have been really excited about is advertising, and what Amazon is doing with advertising. If you're a Prime member, you notice that Amazon recently turned on ads, Romain, for your Prime viewership, and you have to pay a monthly fee in order to turn those off. Amazon, a huge player when it comes to advertising now.
They're certainly a huge player when it comes to advertising. And I think this idea, though, Tim, this idea that they have made that switch, and at least so far, you have not necessarily seen any real ding to that side of the business. But it also gets to the point that this isn't sort of a one-to-one comparison with Netflix. Remember, Prime isn't their primary business. It's really just an ancillary add-on here.
You mean Prime Video?
Prime Video, you're right, to sort of keep people attached to it.
Exactly. Prime is so important to Amazon because if you subscribe to Prime, you buy more stuff from Amazon. Amazon,
Yeah.
you pay more, you shop more, and you pay more for
Yeah.
items. So I mean, if you're in the Prime universe, it's like the more valuable they can make it, the more likely you're going to stay.
Yeah,
It's a virtuous cycle, right?
All right, I think we're actually getting results out of Meta. So let's get to that right now. Meta Platforms, monthly active users coming in at about 3.07 billion. The street was looking for about 3.06 billion on that number here. Not really seeing the fourth quarter numbers just yet, but here's your forecast going forward. 1Q revenue, the company sees $34.5 to $37 billion in revenue. The low end of that range is well above the street estimate of about 33.6 billion. So this looks like a big guide forward here on the revenue side for the company. Again, still digging around for the fourth quarter numbers, but the first quarter forecast, Scarlett, right now looking pretty good.
And also Meta has declared a dividend, a cash dividend of 50 cents per share. Are we in a new world where growth companies pay dividends? What happened?
That is unusual. You know, what's interesting too, Meta, we were talking about it before we got going, has been such a big outperformer this year.
Yes.
Among the Magnificent Seven. Meta's up about 12% year to date. You've got Apple down about 3%.
Yeah.
Amazon, just up a little bit. But it's interesting to see them pay that dividend.
Okay, well, let's go through some of the 4Q numbers here. EPS 533. The street was looking for 491, so that's a beat. 4Q revenue coming in at $40 billion and change. That's a beat versus street estimates of about $39 billion. And then here is the two interesting stories here also coming out of it. The cost side here. They're giving a read here on their total expenses for the current year, 94 to 99 billion. The street was looking for, Alex, 97 billion.
Look at that buyback.
50. Yeah, go ahead.
Announcing a $50 billion boost in their share buyback. So they are really giving a lot to investors here.
Yeah, it's a lot of cash to deploy. And I mean, you wonder, because one of the big stories when it comes to Meta, of course, is that it wants to continue investing in its new technology, in AI, in the reality labs, which hasn't been making money. But at the same time,
Still didn't.
But so far, as we know over the past year, it's been rewarded tremendously for all the cost cuts. How does it balance that? And it's giving back a lot of money to shareholders.
So is this a company that, I know it's still called Meta, but is it still a metaverse company, or is this a company that's back to its basics and it's investing instead of in AI rather than in the metaverse?
Well, if you look at the share of revenue they got from ads, I think it's still an advertising company.
I think so too.
But no.
What a difference, though, 24 hours makes. Meta's up about 8% here. We're looking at Amazon at 4%. We're waiting for Apple, right? Compared to some of the other big mega cap tech that we got earlier in the week, it's a mega different tone, don't you think?
Absolutely. Amazon up 4, Meta up 8, and more headlines on Meta, Carol, as we say goodbye here, that they're going to continue that cost cutting here and our current hiring underrun.
All right. We know you guys will continue to cover our cross-platform ends, radio, TV, YouTube, Bloomberg Originals. Guys, we will see you again tomorrow.
We continue our markets coverage right here on Bloomberg Television. A lot of earnings crossing the wire, including Meta Platforms, a big beat in the raise, and a big give back of cash to shareholders through buybacks and dividends. Amazon also moving higher here on the day after it beat on several metrics and gave a relatively ambitious guidance here on sales. Poonam Goyal joining us right now, senior retail analyst at Bloomberg Intelligence, to talk a little bit more about Amazon. How encouraged were you by this report, Poonam?
The numbers were great. I mean, it was actually as we expected. We saw strength in online sales given a strong start to holiday, and AWS came in above expectations as we thought. So the numbers were good on all fronts. The only weak point here was that physical stores were weak, but that's such a small piece of their business that I wouldn't even be concerned with that. I do think the real nice numbers here were on the operating income side, right? We saw a big beat there. And that's, I think, thanks to two things. One, the AWS business had better operating margins, and also advertising, which had 27% growth. Keep in mind that that segment has a 50% operating margin. Wow. So really, I think the beat that we're going to see from Amazon on operating margin will come a lot from advertising as that continues to drive superior growth.
Yeah, it's pretty incredible, these numbers. I want to go back to AWS because that's what everyone tends to focus on, or that's been the narrative that people can get excited about. And analysts are saying that the bogey for AWS revenue was 13% growth, and that's exactly what AWS delivered on. I guess the question here is Amazon trailing Microsoft and Alphabet when it comes to generative AI, and is it closing that gap a bit here?
Well, I mean, they are set to be trailing the other companies, but that's because Microsoft Azure has the close relationship with OpenAI, right? They have that communication and that helps them. But when it comes to Amazon, we think there's still plenty of potential to really gain momentum in the cloud business. In fact, the growth that you saw, the 13%, is only going to accelerate as the year unfolds. We're looking at high teens growth in the back half.
This gets us to a broader question about the other part of the business, primarily the, I guess, the prime business, if you will, which is kind of now this amalgamation of both the retail side and the build out that they continue to do with regards to video here. How does that actually fold into the broader Amazon story?
Well, the retail side helps drive the digital advertising revenue, and then the Prime Video investments right now may not be profitable, but as you know, they just launched ads on Prime Video just 2 days ago. So as that grows, we think that's a way to make Prime Video profitable too. And all the advertising revenue that they'll generate both on the retail side and on the video side are really going to be big contributors to their operating profit story for the long run.
So what does the CEO need to discuss in the earnings call that's going to maintain this momentum, that's going to keep investors excited about the storyline for 2024?
I think we're all focused on the cloud commitments that they're seeing as we move forward, the backlog there. And if that proves to be encouraging as we would expect, then I think the stock should relatively hold its momentum.
All right.
Poonam Goyal of Bloomberg Intelligence, really appreciate your joining us and giving us the instant analysis on Amazon's numbers. Let's continue to fold in Amazon and also bring in Meta and the broader tech sector with David Kirkpatrick. He is the founder of Techonomy Media, a conference and media company, and of course, author of The Facebook Effect, which chronicled the early days of Facebook, now Meta. So David, you took a look at the numbers and these were wow numbers. And this is something that people had anticipated because it's essentially an advertising company, as Romain reminded us, less of the metaverse and more of advertising. And advertising is where Meta continues to print money.
They print money, and I also think, every company's investing in AI, and actually, in terms of applying AI to advertising, Meta was a little late. Originally, they were thinking of it in other ways, but they have done an extraordinarily good job of applying it. And I think in this case, AI is helping drive revenue and profit growth more than for most of the other big companies. So, I am very negative about this company as a ethical operation, as you probably will recall, but you cannot question the spectacular financial management here. But could I just make one point about this odd dividend thing?
Yes, 50 cents a share.
What a thing. Okay, nothing matters more to Zuckerberg than his image. He was deeply humiliated yesterday in the Senate. I wouldn't be at all surprised if they were not sure whether they were going to announce a dividend and or a big buyback today until they saw how he was treated in the Senate. And he was treated very badly, so they had to put all their wood behind the arrow. Just like how they changed the company name to Meta at the height of Frances Haugen's revelations. This is the way they think. They care most about Wall Street. They don't care about how the world sees them otherwise, and they are brilliant at managing it for better or for worse.
That's exactly where I want to go next, this return of cash to shareholders, right? The 50-cent dividend, the increase of $50 billion to its buyback plan. What does that say about what kind of company Meta wants to be, what Mark Zuckerberg is signaling to Wall Street in terms of how you should value us, how should you view us?
Well, you said before, growth companies with dividends, that's weird. However, they can be both because they are so profitable, and they will remain hugely profitable because their growth now is largely in the developing world where they have no real impediments. They have a lot of problems in Europe and the US and even some other developed countries, but they have so much room to grow in Indonesia and Nigeria and South Africa and Uruguay. I mean, literally every country. So they can be giving dividends and buybacks and having great EPS. I mean, they're just amazing in terms of the numbers.
Well, they are amazing, and they're being rewarded by it for Wall Street doing exactly what Wall Street expects of them. But you mentioned sort of those growth opportunities overseas. I mean, how tangible is that in terms of actually contributing to the bottom line in some way anytime soon?
I didn't see yet the numbers for geography in this report, but it's tangible already. I mean, they are already hugely profitable in a lot of those. And that was not the case for many, many years, where they established a sort of ground operation, or they actually didn't establish a ground. They just translated the service and let people glow, and they didn't even have regulatory oversight or anything. But they have been established in all these countries, and they are the #1 media in almost every country in the world. That is a literal, true statement.
We know that. Does Zuckerberg, though, get the credit for this? Because there was a lot of talk about, of course, the changing of the name to Meta and the refocus on Meta, a decision that, based on public reporting, pretty much came from him and only him.
Right.
And there was a lot of pressure by shareholders as well as folks internally.
Right.
Go back to that ad business. That is our core business. Put the money and the resources there, and you'll get the rewards. That appears what we saw today in this earnings report.
Yeah, I think you're right. I don't think his enthusiasm for the metaverse is diminished, even though he knows it isn't going to be nearly as quick as he had hoped. But, he is a very pragmatic leader. And he also is, like I said at the beginning, so obsessed with image. And if Wall Street told him to refocus on ads, that mattered to him. And, it's also interesting, Sheryl Sandberg's now gone. They're still doing so great with advertising. But she did lay another fantastic foundation, because she is an ad master, and she put in place all the people who were there. And they're good people.
Of course, the negative side to the story about Meta is the regulatory pushback, particularly in Europe. And there are some concerns about how Meta is going to have to change the way it handles user data. Is that going to be kind of any kind of blueprint for how the U.S. might approach Meta and the data?
Forgive me for saying so, but I hope so. But certainly, it is already changing the way they operate. They're already having to segment out certain user data. GDPR, they got a huge fine. There's a new law that's forcing them to really rethink how they connect Instagram and Facebook in Europe. It will affect their revenues in Europe, although they're so good, and they also have such tools now with AI to find sort of ways to keep making money with ads, even despite these roadblocks, that I think it won't hurt them that badly.
All right, let's also bring in Mandeep Singh. He's the senior technology analyst for Bloomberg Intelligence. And Mandeep, I'd like you to just tell us what Meta's advertising revenue looks like when you compare it to some of its competitors, whether it's Alphabet, whether it's Amazon.
Yeah, I mean, look, the comps were quite easy going into this quarter. Remember, last quarter, same year, you had a decline. So Meta was struggling. So comps were easier, but the fact that, they grew 25% is a sign that you're seeing that cyclical recovery in digital ad spending, which, I would want more proof points from Snapchat and Pinterest to show similar numbers, because in the past, when digital ad spending kind of goes up and there is a cyclical recovery, it lifts all boats. So we haven't seen that yet. But look, in this case, clearly with 25% layoffs, they haven't missed the product cadence, and they have delivered in terms of, kind of getting to that growth.
How do you quantify, though, I guess, the quality of these ads? I know anecdotally, a lot of folks on Wall Street seem to think that Facebook and the other properties do a much better job with the targeting of the ads than some of their competitors.
Yeah, and that's what that was the focus for Meta over the past 6 months. They were focusing on first-party attribution. Remember IDFA and all the challenges that brought for Meta. That's why they had a decline last year. So they clearly seem to have overcome that. And look, in the end, I think Facebook or Meta has that kind of user knowledge that they can target the ads much better. I would call out one more kind of metric here, that ad pricing grew for the first time after 7 quarters. So you had 7 quarters of decline. This is the first time, even though it grew just 2%. But it seems to have inflected, and that's a sign that their targeting is getting better.
So, David, do you think Zuckerberg will stay this course, or is he going to end up looking back on that shiny thing when it comes to the metaverse and decides he wants to pour some of the money back into that?
He will. He's going to have so much money to work with, he'll still be able to build the metaverse. Is what
Even after giving it all back to shareholders?
He's not giving it all back because there's so much. And their targeting has always been uniquely good. And targeting ads is the holy grail in advertising. So they continue to essentially lead global marketplace in ad targetability. I don't know if Mandeep would think that's an overstatement, but to me, that gives them incredible resources across the board.
They have the best systems systems, which is why, when you look at the engagement of a Meta versus a YouTube or any other platform, Meta monetizes at a much higher rate because their targeting is better and they have better systems. So clearly it's reflected in the numbers, but I do think, you have to think about user growth and engagement, and that's where the Blue app declining is still a concern, but for now, I guess people don't care because they grew 25%.
I'm glad you bring that up because obviously Meta has different platforms, whether it's the Blue brand, Facebook, whether it's Instagram, whether it's WhatsApp. When it comes to AI targeting, AI ad targeting, how much is Meta really leveraging its different platforms here? Or are we only at the beginning, the early stages?
One of the things they're thinking really hard about and starting to do is figure out targeting based on user behavior across various platforms. And that is an asset because, for example, they can't really monetize WhatsApp very well, even though it's the de facto communication system for the planet, right? But they have a lot of data from it that they can use. And I'm sure they're already using it for targeting ads in Instagram and Facebook. So could I just make another point that occurred to me as I'm sitting up here? Everybody's watched Musk seemingly destroy Twitter, and yet Twitter's still functioning, right? Mm-hmm. He's got rid of practically everybody, and it's still going. And, you saw Yakarina yesterday in Congress, kind of confident that things are going okay. I think people like Zuckerberg have watched that, and probably other people at Alphabet and even Microsoft, and they say, wait a minute, maybe we could get rid of more people than we thought, too. And they all have now, which they never had done before. They pretty much all started laying people off after Musk took over Twitter. So it's just interesting to think about that.
This gets us to a broader question then, Mandeep, excuse me, to build off what David was talking about. This idea then here, if this is the case, if it is that easy to do it in terms of the Twitter, basically just to put in a neutron bomb there and still managing to still operate, does that mean the year of efficiency over at Meta can continue maybe even at the same pace that it was in 2023?
I think the cost cutting is behind us. Yeah. So right now, I think what's really working for Meta is the fact that they have a Gen AI strategy, they have a large language model, they have open sourced it, and they're actually using it for ad targeting. So the difference between a Meta and a Snap and Pinterest is Snap and Pinterest are still way behind in terms of, applying generative AI because they are a much smaller company. Whereas Meta, if you think about their GPU spend and data center spend, it's equivalent to hyperscalers, even though they don't have a cloud business. And that is what is helping them with the generative AI strategy for sure.
And they did say actually in the release here that they do plan to grow this year, reducing what it calls our current hiring underrun.
Interesting.
Yeah, in fact, Meta says it completed its employee layoffs that began in 2022 as of December 31st. But when it comes to total expenses, and we go back to that, the cost part of the Meta equation, it still sees 2024 total expenses at $94 billion to $99 billion. The consensus estimate was $96.5 billion. So, Zuckerberg has gotten rewarded for the year of efficiency. And
he was.
Yeah. He will continue to be rewarded. And this is a theme that kind of carries over. How much more fat does Meta have to cut?
If they wanted to, there's plenty, but they clearly, as Mandeep said, they don't even want to. I gotta keep repeating, I don't like these people. They are incredible financial managers. The money is gonna keep rolling in.
All right, sure. I do just want to take a break from that real quick. We are getting some additional headlines out of Meta, and I'm wondering if, Mandeep, you can weigh in on it. This is involving that FTC consent order. Meta saying that the FTC is seeking to substantially modify that consent order and may impose added restrictions on its ability to operate, and that if the contesting it is unsuccessful, it would have an adverse impact on its business.
Look, regulators definitely perceive harm, especially when it comes to kids and, the effect that Instagram may have. And that's not going away. So Meta will always get that scrutiny. Yeah. And in this case, they will comply. You saw the testimony yesterday.
Comply, but is it really an overhang? Because I know we always talk about it as overhang, but I feel like we've been talking about it as overhang for the last 12 years.
For a company of Meta size, where they clearly built on acquisitions that in hindsight regulators didn't want to allow, there is a risk that, they can be forced to break up, although that risk is still fairly low. There is no precedent for that to happen, at least that I can recall.
David, do the regulatory overhangs go away if we get a new president in November?
Not really, especially if the U.S. is copying Europe. Europe is not going to stop coming down on big tech. In fact, they are going to ratchet that up steadily for the foreseeable future. And they do create a model the rest of the world more or less follows.
Okay, so when Europe lays everything out, when European regulators look at these financial results, what are they thinking?
They can afford to pay more fines. I don't know. You know, I think Meta's paid like $1.5 billion in fines in Europe in the last year, something like that. I don't know. I don't think they think of it in those terms. In fact, because the European regulators, they're not financial people. Privacy is their obsession.
Yeah. I mean, Meta is pivoting to a subscription model in Europe. So if you don't opt into the privacy, you have to pay for the app, which no one wants to. So clearly, I think users will eventually prefer the free option where they, subscribe to ads or get those feeds where there are ads as opposed to paying for the app. But clearly, I think there are things that Meta is doing right now, including a partnership with Amazon, where they will be sharing data so that Meta can have in-app shopping. Now, that is something I do think regulators will object to, because Meta sharing data across its family of apps
That's one thing,
is one thing. But Meta and Amazon sharing data for in-app commerce, I think that's going to raise a lot of
How
flags.
much does that differ, though, from the program that they already have on Instagram?
Well, so right now, what Amazon is doing is they're saying we want to partner with every social media platform. This is not exclusive to Meta. They're doing that with Snap and Pinterest. And clearly, it depends on what data they're sharing. But you can't enable, in-app shopping if you're not really sharing a lot of personal information. So it'll be interesting to see how that works out, the shoppable ads they're talking about.
Why does Meta need that part? I understand why Amazon needs it. Why does Meta need it?
I mean, all these companies are looking for more first-party data for targeting. Remember, they're trying to circumvent what Apple took away, all the data that they could track. Now you have to make up for that data by tracking, by sharing.
By colluding with other
They've always wanted commerce, too. Facebook Marketplace is huge. It's not hugely profitable. But if they could get into e-commerce, it has been a holy grail for them from 2004. I mean, Zuckerberg didn't care the first year. But basically, once they started caring about money, they've always wanted to do commerce. I'm not sure I agree with Mandeep, though, because I don't really know what law that would break.
All right, we're going to have to leave it there, guys. Great conversation. And our thanks there to David Kirkpatrick over at Techonomy and our very own Mandeep Singh, one of the best over at Bloomberg Intelligence. A nice breakdown of the earnings that we got out of Meta. Those shares in after hours trading right now at after hours highs, up about 13% as we wait for the biggest of the biggest to report here. Apple set to report in just a few minutes. Full coverage once those numbers cross the wire. This is Bloomberg. Apple earnings crossing the wire right now. Revenue coming in at about $119.5 billion. The street was looking for roughly about $118 billion. iPhone revenue 69.7, slightly above what the street was looking for at 68. And Greater China revenue coming in at about $28.8 billion. That's a bit of a miss from what the street was looking for at 23.5. Scarlett, the EPS also coming in for that fiscal first quarter at $2.18 a share. That's unadjusted. That beats street estimates of about $2.11.
And the service revenue, which is the more profitable part of its business, certainly when you compare it to hardware, $23.12 billion. That is shy of what analysts had anticipated, which was $23.37 billion. And I go back to that revenue number that you pointed out at the start, $119.58 billion.
Yeah.
That is growth. So Apple has managed to avoid a fifth straight quarter of sales decline. It has ended 4 straight quarters of sales declines.
Yeah, its first sales gain here in the year, though a lot of that, of course, coming here in North America and not necessarily out of one of the more important markets, China. Emily Chang standing by right now. She's the host and executive producer at Bloomberg Originals. She just got off the phone with Apple's CFO. What did he have to say about China?
Romaine, look, I think the high level here is a beat on revenue after 4 quarters of declining sales, record earnings, and a beat on iPhone. But there's definitely a meaningful decline that we're seeing in revenue in China. I did just speak with Apple CFO Luca Maestri. He said, we're not happy with it, but we know that China is the most competitive market in the world, and we do still see a lot of long-term opportunity there. He did call out that the iPhone declined less than the other product categories. That is, the iPhone did better than the other product categories in China. He said that they saw a record number, a record install base. They're still seeing strong growth in upgraders, but again, this is a market that folks have been very concerned about based on replacement cycles, based on, bans on foreign technology in the workplace there, reports that Apple is cutting the price of the iPhone in China, so definitely a market to watch, as always.
Right, and I'm glad you mentioned the iPhone, because when we look at iPhone revenue, it still makes up the majority of Apple's revenue, despite all the different products and, of course, the emphasis on services. $69.7 billion, beating analyst estimates of $68.5. Can you give us some more color about the iPhone? What did he say?
Right. The iPhone, he called out emerging markets, saying they're seeing double-digit growth in emerging markets around the world. These are markets that get a lot less attention than China. Huge markets like India, like Indonesia, markets that have a lot of potential. Again, he talked about a record number of installs globally for iPhones, also a record number of new upgraders. And, I want to talk about that services number a little bit because, there was a miss on services, but there was also some growth and a new all-time record.
What did he have to say about the Vision Pro? I know it's still a very nascent product in terms of sales, but what's the expectation here on how that's going to perform?
Well, it is out tomorrow, so very excited for the public to be the judge of that. And I actually got my Vision Pro demo last week. And to be honest, it is a remarkable piece of technology. And he certainly emphasized that. He talked about the phenomenal reviews. He talked about a lot of promise in the enterprise, said a lot of companies are really interested in investing in the Vision Pro. So that's going to be an interesting opportunity. Of course, it's expensive. It is going to be a niche product, certainly, at least initially. And the big question is going to be how developers show up to the party. But I will say, personally, from my own experience, even some of the most basic things are pretty incredible, that you can look at a virtual button and tap your fingers and an app opens and you're suddenly in the middle of, a room with 3D dinosaurs. It's pretty cool, but I think that price tag is going to be the decider. And what is the killer app experience? That's still the question.
Yeah, absolutely. Here, Emily Chang, a nice breakdown here of her conversation with the CFO over at Apple. Those numbers crossing the wire, a beat on a lot of the top and bottom line metrics, but some softness in the shares, down about 1.5% here in after hours trading. As we continue the conversation with Gil Luria, senior software analyst over at D.A. Davidson. He's got a neutral on Apple and a 166 price target here. This is a company, of course, still dependent on the iPhone, but as Scarlett was pointing out, probably even more dependent, at least in terms of profitability, on that services side of the business here. What did you make of the numbers we got, Gil?
Well, so the services number being light is probably the concern that's weighing on shares after hours. That is the growth engine. They have the huge install base. That's not going to grow very fast. What they really need to grow is how many people are using that and spending on these services. Let's not forget that all the regulatory threats from both sides of the Atlantic are coming after the services business, trying to limit the App Store and what Apple can do there, and forcing Apple to open up to other vendors and application providers into that App Store. So if they start losing growth in that business, then it's harder to see how Apple can grow anything more than low single digits.
There's been a lot of talk about how the services revenue was so dependent on the iPhone sort of the ecosystem, if you will. But we've sort of seen that top out. And there's always been this discussion here about the next sort of hardware product that feeds into that services side. I know the Apple Watch did deliver some of that. And now we have the Vision Pro, which, at least based on the initial estimates, isn't necessarily going to be a big seller. But is there a future for that in that Apple ecosystem where it will be material to the bottom line?
Yes. I think that Emily's observations are very consistent with what other folks have said, which is it's a glimpse into the future. But that means 2, 3, maybe 5 years out, we have an affordable product that's a little bit more comfortable, that folks will keep on their heads for a little bit more than 15 minutes, then it can be a really big category that changes how we experience and use technology, how we immerse ourselves in a connected world. Not this year, not next year. Now, this year, if they come in and tell us they have 500,000 pre-orders on the Vision Pro, that's about a 1% increase. That could be interesting, even though it would probably cannibalize some other products. I don't think they're going to be able to say that. It sounds like the number is going to be lower than that for pre-orders. Now, what I would say on the iPhone, though, given the shortfall in China, the fact that they were able to grow the business with that shortfall in China and a product that really didn't add much over the last generation is also encouraging. If they can come up with a reason for iPhone 16 to be an even more meaningful upgrade, they can grow that line of business as well.
Well, that's the question, right? I mean, the last couple of iPhones don't really prompt anyone to necessarily upgrade and spend another $1,000 for a phone. I still have my iPhone 12, and I don't really see much of a difference between 12 and 15 in terms of actual bells and whistles. Yes, there's a better camera, but I mean, we've had a better camera since iPhone 10. So what is it that Apple needs to do if it's so much more reliant on the iPhone when it comes to hardware? I was looking at the Mac, the iPad, and wearables. All of those were misses compared with analyst estimates. What does it need to do to deliver on the iPhone? Maybe not in Greater China, but in the rest of the world.
So what I would look for is the World Wide Development Conference in June. If they come with a set of generative AI capabilities that will only be available in the iPhone 16, we could get a more meaningful upgrade cycle. The reason you and I bought the 12 is that it was the first phone with 5G. And to your point, 13, 14, 15, not that different. If the iPhone 16 is the only phone that can really deliver on new generative AI capabilities, then we could have a bigger upgrade cycle.
That's a good point. All right. In terms of the financials here, Apple has maintained its quarterly dividend at 24 cents a share. We were just reporting about how Meta has announced a dividend of 50 cents a share and has added $50 billion to its buyback. Given that Apple's falling after its earnings report, does Apple need to up its game when it comes to returning cash to shareholders?
It has an opportunity to do that, but it's already very reliable with I mean, we're talking about Apple and Microsoft have a better balance sheet and better credit quality than most sovereign countries. They are part of the reason folks pay up on multiple wise for those two companies is that it's as sure a thing as you can get in the stock market. But Apple can fine tune the amount it returns to shareholders in order to make sure that it's supporting its stock when it does have a little bit more lackluster growth as we've seen recently.
All right, Gail, really appreciate your joining us. Gail Loria, Senior Software Analyst at D.A. Davidson. And of course, we want to focus in on the iPhone a little bit more. This is Apple's most prized commodity. And we know that even after building out its business with other devices and services, the iPhone still makes up more than half of overall revenue. So where do things stand with this smartphone, especially when compared to its Asian competitors? Nabila Popal is Director of Research for the International Data Corporation, specializing in looking at handsets. Nabila, you took a look at the results. What can you tell us about the iPhone, especially given that Apple kind of missed the mark when it comes to revenue in China? Yes, it grew, but it was not as much as analysts had anticipated.
I mean, honestly, and you know, others have mentioned this, it's what Apple has achieved this year is a tremendous success. Of course, you know, it might not have gone as high because of the challenges it faced in China, but given, I would, you know, flip it around, that given the challenges in China, despite the increased competition from Huawei that it saw in now what is its largest market, we saw Apple hit, you know, break records, not only to become the #1 player annually in China, but also globally. So, you know, there's a lot of things that have been going for Apple over the past few years, actually, which has what led it to its, you know, reaching the top finally in 23 and crossing Samsung for the first time, I mean, ever. So that's a big success, especially again, in light of all the challenges and, all the negative media that's been happening that it's been facing. I think this is a great, tremendous success for Apple.
Just a quick correction. I meant to say sales in China plummeted, but overall revenue growth for the first time in about a year. Romain?
Nabila, this gets us to a question, though, when we talk about the competition now out there and really the idea that you don't have as much differentiation between some of the different brands here. We saw, of course, with the rollout of that Huawei model last year, and I know some of that was quite frankly about politics and nationalism, but there was also a good phone, if you believe some of the reviews out there here. And I'm wondering how worried should Apple be about some of the advancements that you are seeing out of Huawei and some of the other Chinese handset makers?
I think the biggest challenge now for Apple, yes, it's taken the crown and, made headlines and done tremendously well. But it will be the challenge will be in keeping that crown, right? And how is it going to align itself this year, especially as the overall smartphone market recovers? I mean, a large part of Apple's success or reaching the top, on top of, all the advantages that come with the Apple phone or the ecosystem and its strength overall as a brand, be it, in China or globally, was also, its growth also had to do with the fact that the Android part of the market was declining. Now with recovery in full play this year, we're expecting almost a 4% growth of the overall smartphone market. The Android part and hence its competitors are going to grow at a rapid, much more faster pace.
Yeah.
So it's going to be more challenging for Apple to kind of keep that leadership. And on top of that, not just in terms of volumes growth, but also we're seeing, tremendous phones coming out, whether it's just from, Google, although in smaller volumes, or Huawei, very much doing very well and is expected to continue to do well in China, and then probably expand later on, but not so much this year. What Apple really needs to, I think, look at is how is it going to maintain that? And its competitors are really going gung-ho with the whole generative AI capabilities. We've seen that again from Google, from Samsung in their latest launches.
Yeah.
And Apple has kind of been quiet, right, about that subject, which is gaining so much steam. So I think they, not to say that they aren't looking into it or they don't have enough, of course, to some degree. We all know that AI has been part of smartphones for many years now, not so much the generative AI that is recently being talked about, but, so they really need to look in that and probably gauge, bring that into their devices in a bit more obvious way, right? Rather than moving backwards.
It's certainly behind the scenes, and we know that a big part of the whole Vision Pro rollout is sort of tied to what they've been working on behind the scenes with AI. Whether that translates into the actual handsets at some point and we start to see that technology in there remains to be seen. We're still talking also about a strategy that Apple has taken, and we're going to talk a little bit more about this with our next guest. The idea of sort of this closed ecosystem that has basically been their hallmark. For a lot of buyers, that's actually a plus. But we also know that for a lot of folks who gravitate to the Android system, that is actually the big negative. And I'm wondering, have we reached sort of a critical point where Apple needs to rethink that sort of walled garden?
It's funny you say that because, like you said, it's pros and cons, right? It's been its greatest strength, and it's kind of helped lock in consumers right into that. And when you look at the data, you see that the amount of people that once they use an Apple device going back to Android are fewer than the ones who switch over, switchers from Android to iOS.
Yeah.
So it's definitely helped maintain its lead and the whole user experience. Even though Apple might be late, like quote unquote, late to the game, even with AR, VR, right? And with Vision Pro, we've seen how much success it's had. We do know that, Apple takes its time to do things and really focuses on the user experience. So even with AI, I'm eager to see when they, or with generative AI, when they bring that into their devices, how it'll come into play. So, it remains to be seen.
All right, Nabila, going to have to leave it there. Great insights. Nabila Popal, Director of Research for IDC here. And we continue that conversation really about that walled garden here as Apple makes that big bet on the Vision Pro headset as a long-term growth driver. But as we've talked about, it's going to cost you $3,500 for that device. And more importantly, a lot of the big apps that you would normally get on your iPhone, they're not actually going to be available on that Vision Pro, and there's a reason why. Aaron Vey is joining us. He is a software developer who specializes in Apple platforms and has written iPhone and iPad apps for major companies, including Warner Brothers and Disney. And Aaron, let's get right to it. I mean, when I saw the announcement that we weren't going to have things like Netflix on there, because I guess they're in a little bit of a wait-and-see mode, the developers, I should say, in a wait-and-see mode as to whether they want to participate in that, it does raise a lot of questions here about whether developers still see the Apple ecosystem as worth the effort.
That's a great point. Thanks for having me on, by the way. Developers have been coming along with Apple for years and years, since 2008, and I've been a developer for all of that time, working with Apple platforms. At the beginning, the iPhone was a wonderful platform to start with, not just because it was the very first proper computing platform in a mobile device, but because it had a huge opportunity for third-party developers to write software for it.
Right.
At the time, we didn't really see a problem with Apple's strictures on getting apps into the store. Their need for review, the 30%, that was fine at the time because it beat pretty much every other way to the market for software developers, and that's no longer the case.
That's no longer the case, and you draw a contrast between Apple's products and the Mac, which you say is much more open and welcoming to developers.
That's right. The Mac is a traditional computing platform in the sense that anybody can write software for it and doesn't require any participation from Apple in order to run your apps on that system. So as a Mac developer myself, it has a very different business model, and it's something that we really appreciate and wish that we could take advantage of on other platforms that Apple makes, because they make the best hardware. The Vision Pro is just their latest move that excites us all. Seeing the Vision Pro come to fruition is not a perfect device, but we can see very clearly into the future that this thing is going to be astounding and probably a future direction of computing. We want to put our software on it, but the limitations that Apple gives us makes that a less exciting opportunity. And given how they've treated developers for the other platforms, the ones where an iPhone, for example, being in the hands of over 1 billion people, you have to be there. But for a platform like Vision Pro, which is brand new on a few thousand people's faces, maybe that's not the place that we have to go right now.
So, Aaron, do you see the company changing its approach towards developers with this new device, with the pressure from regulators, especially in Europe, to kind of loosen the reins a little bit on the 30% toll and the walled garden?
Not willingly. I don't see it happening willingly. But boy, we would very much like it. And by we, I mean developers, because there's just so much difficulty in getting your apps to market and going through Apple's requirements.
All right, Aaron, great to catch up with you. Aaron Bay there, a software developer here. Discussion here about that walled garden here and whether app developers really see any incentive to continue down that road with Apple. We should point out, Scarlett, 3 of the biggest tech companies out there, all the big movers in after hours trading. Apple shares down a couple of percentage points. Amazon up about 8 percentage points. And of course, Meta having a phenomenal after hours session, up about 14. A lot more coming up here on the program, including a look ahead to a big jobs report tomorrow. This is Bloomberg. Another busy day in markets tomorrow could even be busier. A big U.S. jobs report set to drop at 8:30 a.m. Washington time. Blorina Urucci joining us right now for a preview. T. Rowe Price's chief economist. 185,000 jobs created in the most recent month. That's the consensus estimate on the Bloomberg terminal. And Blorina, that's pretty much in line with the post-GFC average.
That's right. We've come a long way in terms of cooling in the labor market. The pace of job creation has slowed significantly. For all the fears of recessions and mass layoffs during 2023, that did not materialize either. So I think this seems like a sweet spot for the Fed. My expectation is that tomorrow we get somewhere in the range of 150 to 200K. That's very much consistent with an orderly deceleration. However, we have to bear in mind tomorrow we're going to see a bunch of revisions, both to the establishment survey and the household survey. There's going to be benchmarking in terms of jobs, but also population. And so this January reports have tended to surprise, to deliver big surprises. So we have to be aware of that tomorrow.
That's a great warning. Thank you for the heads up on that. What does that mean for wages? Are we going to get a clean read of wages then in the January jobs report?
I think, as I said, similar to employment with the wage data, we could get surprises and distortions because of the benchmarking and the revisions. But really, the clearest signal on wage growth comes from the employment cost index that was not distorted during the pandemic as much as other measures because of distributional effects and compositional effects. We know the Fed looks at that very closely, and already this week we got an indication that there is some slowing there, some broadly based slowing in terms of wage pressures. And I expect that to continue in Q1 of this year.
When you look at sort of the complexion of the labor market, a lot of the layoff announcements that we've gotten, and an unemployment rate that's still holding below 4% and really not expected to budge a whole lot, at least based on the Fed's own projections here. Are we looking at a softer labor market, but one that maybe will come without a huge loss of jobs?
It seems that way at the moment. And really, the key here is that a lot of the slack in the labor market has been created through the vacancy rate. But we are also noticing that the quits rate has gone all the way back to pre-pandemic levels. What this tells you is that workers don't feel as confident switching jobs anymore as they used to. This is a clear indication to me that demand for labor and hiring has really cooled down a long way. But then when you look at various measures of layoffs, they're not telling us that there is broadly based mass layoffs across industries, just some pockets of weakness so far.
All right, Blarina, I have to leave it there. Great insights. Blarina Urucci over at T. Rowe Price, a big jobs report. Of course, the team surveillance, John, Lisa, and Marie will have full coverage, 8:30 a.m. Washington time.
And as you mentioned, the consensus estimate here is for growth of 185,000 jobs after 216,000 were reported for the month of December, but distortions.
And also that's normal, because I wouldn't look back, because we've been obsessing so much about this drop in growth in the labor market, but we're kind of just dropping back to what would be a normal trend line after the pandemic kind of
upended pretty surprising given how many interest rate increases we've had and how long it's been since the Jay Powell and the Fed began raising rates that there hasn't been more of an impact.
We also get another economic report tomorrow, and that includes the UMich sentiment numbers.
Yes, and what'll be interesting there, of course, is inflation expectations. Whether it's 1 year or 5 to 10 years, everything's in that sub 3% range.
But remember the last one we got, and those inflation expectations actually came down just a little bit, right? So I don't know, maybe the consumer is feeling a little bit better.
Will this give the Fed greater confidence?
Who knows? What gives Jay Powell confidence? I think we can do a whole show on that, right?
Yeah, we have.
We also get a lot more earnings as well tomorrow, including from some big energy companies.
Yeah, both Exxon and Chevron, we'll expect them to talk a little bit about their big recent acquisitions. Also the healthcare space, Cigna and Bristol-Myers Squibb.
All right, of course, we'll have full coverage of that right here on Bloomberg. Stick around, all your politics coverage coming up on Balance of Power. Scarlett and I will be back tomorrow. Thanks for watching. This is Bloomberg.